So we'll talk about investment real estate first. Obviously, with a little bit more risk, you're looking at more conservative loan to values. We're looking at the lower of the appraised value or the project cost. And typically in investment real estate, it's anywhere from, I've seen as low as 60%, but not usually any higher than 75%. Cash flow covenants are very common. One example of a cash flow covenant might be a pre and post distribution covenant. I'm not sure if you've seen that before. But investment real estate, you want to make sure that the project, the underlying project is solid, and that would be throwing off a cash flow of $1.35 for every dollar's worth of debt. That would be the explanation for that covenant. But a single purpose entity, LLC, that owns real estate may not want to accumulate a lot of excess cash year over year over year, so they'll allow distributions to come out of that entity and bring the cash flow down to a 1-to-1. So that's kind of a common cash flow covenant you might see in investment real estate. As David said, balloons and call options are common, usually matching the term of the lease. So if you've got that CVS deal and it's got a 10-year lease, the bank probably wants to see a 10-year balloon or a 10-year call because we want to know what's going to happen at the end of 10 years. Amortizations are anywhere from 15 to 25. Typically 20 is what you'll see. And banks today, more than ever, would love to see a meaningful relationship aside from the loan that comes along with it. If the owner says, I've got $1 million investment account and I'm not happy with my broker, you guys, I met your person and they're solid, I'll bring that over along with this $5 million investment property loan. That will mean a whole lot to your banker. Most banks look at relationship pricing. We all have modeling that shows the yield on the loan, the fee income that you get from investments, and we can price the loan accordingly. So keep that in mind as well. Yeah.
Could you explain the 1.35 again?
Yeah, sure. So it's basically the property is throwing off excess cash flow of 35 cents for every dollar's worth of debt. So let's say the property is generating $135,000 after expenses. Okay? $135,000 of cash flow. The debt service, let's say, is $100,000 a year. That ratio would be 1.35 to 1. Does that make sense?
Service. You just said, you first said debt.
I'm sorry, yeah, debt service, not the overall loan amount, yeah.
You never get enough.
No, exactly, yeah. That's annual debt service, yeah. Yeah, any other questions, just please, feel free to interject. Key components to a project, I don't think there's anything that's real surprising there. Obviously, the credit of the tenant is very important, the terms of the leases. Anything that has a speculative element to the real estate project, banks are going to try to mitigate that risk somehow. Most commonly, you see a cash flow reserve. Might be 1 year's worth of debt service, or maybe 2 years, maybe a minimum personal liquidity covenant. So if the guarantor has, marketable securities of $1 million, they may say, hey, just make sure your marketables don't go below $500,000 until this property gets fully leased up, until you re-sign that tenant whose lease expires in 2 years. And maybe those covenants over time can be negotiated away. But up front, if there's speculative risk, that's a common way to mitigate that. Don't be surprised also if the bank asks a lot of questions about other projects than the specific investment real estate project you're considering. They want to know more than ever the global picture for you. So what other projects do you have going on? Who are the tenants in those buildings? What's your debt service on there? What happened back in, a few years ago, a lot of real estate developers were involved in so many projects. Maybe one project was doing well, but 3 others were falling apart. So the whole house of cards came down in those scenarios. So banks want to ask a lot of questions about the global picture these days.